The Toronto market pivots. Toronto's real estate market just triggered a signal we haven't seen in years, and it changes everything for 2026 strategies. If you have been sitting on the sidelines waiting for a sign, this is it. But be careful what you wish for. We are witnessing a massive conflict right now. On one side, we have prices falling, creating that affordability window everyone has been begging for. On the other side, we have inventory levels rising so fast, it is making heads spin. Usually, the market moves in a gentle wave, but right now, it looks more like a cliff. Let me give you the one number that defines this entire situation: 27,808. That is the number of active listings currently sitting on the Toronto Regional Real Estate Board. 27,808. To put that in perspective, that is not just a healthy supply, that is a flood. We haven't seen buyers have this much power or this much choice in a very long time. But here is the catch: despite this flood of options, buyers are scared. They are looking at the headlines, seeing the volatility and freezing up. But if you know how to read the data, you know that fear is actually your best friend as an investor. Today, I am going to break down exactly why this inventory pivot is happening, why prices have officially dropped significantly, and how the new financing rates are about to light a fire under this market. We are going to look at the hard numbers, not the fluff, so you can decide if you are making a move now or waiting until 2026. Price reality check. The 7.2% drop. Prices are officially down over 7%, but looking at the averages alone will cost you money. Here is the breakdown. Let's look at the actual receipt. The average selling price across the GTA is currently sitting at $1,054,372. Now, if you just look at that number in isolation, it sounds like a lot of money, and it is. But context is king in real estate. That figure represents a 7.2% decrease compared to exactly this time last year. Think about that for a second. In a market that historically only knows how to go up, we have erased over 7% of value in 12 months. For a typical home, that is tens of thousands of dollars remaining in your pocket rather than going to the seller. But here is the reality check. What does $1 million actually buy you right now versus October 2024? Last year, if you were shopping in the $1 million range, you were likely getting into bidding wars for semi-detached homes or smaller detached properties in the suburbs, usually waiving conditions just to get a seat at the table. Today, that same budget is getting you into detached territory in decent neighborhoods without the pressure cooker environment. You are negotiating inspection clauses again. You're asking for repairs. The dollar is stretching further because the competition has evaporated. However, don't just celebrate the drop. You have to ask why it's dropping. It's not because the homes are worth less in terms of bricks and mortar. It's because the purchasing power was crushed by rates, forcing sellers to recalibrate their expectations. We are seeing a correction that brings us back to reality. But here is where you need to be careful. That 7.2% drop is an average. In some pockets of the 416, condos are down double digits, while turnkey detached homes in high-demand school districts are barely budging. If you walk into a negotiation assuming every seller is desperate because the average is down, you are going to insult the seller and lose the deal. You need to look at the micro data for the specific neighborhood. But broadly speaking, the price ceiling has lowered. Sellers who were holding out for 2022 prices are finally waking up to the 2024 reality. They are realizing that if they want to move inventory, they have to price it for today's beer, not yesterday's fantasy. This price compression is painful for sellers who bought at the peak, but for you, the beer entering or moving up, this is the relief valve opening up. We are seeing price points that actually make sense relative to income for the first time in a long cycle. The inventory tsunami. With nearly 28,000 homes sitting on the market, sellers are losing their leverage, but not all listings are created equal. We need to talk about this inventory tsunami, because tsunami is not an exaggeration. we are looking at a 17.2% surge in active listings year over year. That is a massive double-digit jump in supply. To break it down further, just this month alone, we saw 16,069 new listings enter the system. That is over 16,000 homeowners raising their hands and saying, "I want to sell right now." Why is this happening? It's a combination of investors offloading cash-negative condos and homeowners who can no longer stomach the renewal rates on their mortgages. The supply is flooding in, but here is the strange psychological effect it is having on the market. Improved selection is actually paralyzing buyers. It is the paradox of choice. When there were only 2 houses for sale, you fought for one of them. Now that there are 20 houses on your street for sale, you sit back and wonder, what if a better one comes up next week? Or why isn't anyone else buying these? This hesitation is causing days on market to stretch out. Listings are growing stale, and a stale listing is blood in the water for a shark. This is where the opportunity lies. When you have active listings sitting at 27,808, you have 27,808 sellers who are waking up every morning wondering if today is the day they get an offer. The leverage has completely shifted, but you have to filter through the noise. A lot of this inventory is what we call aspirational inventory. Garbage listings priced high by sellers who don't need to sell. You need to identify the motivated inventory. The 17.2% increase in active listings means you can finally take your time. You can view a property twice. You can bring your contractor through. You can look at the comparable sales without feeling a gun to your head. This environment is toxic for sellers who are uneducated about the market, but it is a gold mine for buyers who are disciplined. We are seeing absorption rates plummet, meaning the speed at which homes sell is slowing down drastically. The backlog is building up. If this trend continues into the winter months, which are historically slower, we are going to see inventory pile up to historic highs. That means even more pressure on prices to come down. This isn't just a seasonal blip. This is a structural shift in supply that we haven't had to navigate in over a decade. Where did the buyers go? Almost 10% of the buyer pool vanished this October. We found out exactly what they are waiting for. Let's look at the sales volume, because supply is only one half of the equation. Demand is the other, and demand has taken a hit. We saw a 9.5% decline in total sales compared to last year. That is nearly 1 in 10 buyers who were active last year deciding to sit this one out. That is a significant chunk of demand removed from the marketplace. Why? Because the sentiment has shifted. People aren't afraid of missing out anymore. They are afraid of overpaying. This drop in sales volume, combined with the surge in listings, has dramatically shifted the sales to new listings ratio, or SNLR. This is the metric we use to take the temperature of the market. It has shifted from 29% up to 38%. Now, technically, anything under 40% is considered a buyer's market. Even though the ratio bumped up slightly to 38%, we are still firmly in buyer territory. But 38% is a tricky number. It suggests that while there is some absorption, it is weak, it is fragile. For every 10 homes that get listed, only about 4 are selling. That leaves 6 homes sitting there, adding to that backlog we talked about earlier. So where did the buyers go? They moved to the rental market, or they are living in their parents' basements waiting for interest rates to drop further. They are trying to time the absolute bottom. But here is the danger in that strategy. When 10% of the market steps back, they don't disappear forever. They build up like water behind a dam. This is pent-up demand. The moment the math makes sense again, that 9.5% plus all the new buyers will flood back in. Right now, the market feels quiet. Open houses are empty. Offer nights are non-existent. But this silence is deceptive. The buyers are there. They are just watching. They are educated. They are pre-approved. And they are waiting for a signal. The sales volume analysis tells us that the market is currently inefficient. Properties are mispriced, and buyers are on strike. This standoff is what creates the 7.2% price drop we discussed. But as soon as that sales volume ticks back up, even by a few percentage points, that 38% SNLR is going to shoot up, and we will be back in balanced or seller territory before you know it. The financing trigger, 3.45% rates. A variable rate of 3.45% seemed impossible 6 months ago. Now that it is here, the affordability calculation has completely flipped. This is the trigger everyone was waiting for. We are finally seeing the lowest 5-year variable rates hitting around 3.45% for insured mortgages. That is a psychological and financial milestone. Let's do the math on what that actually means for your wallet. On a typical mortgage balance, the difference between the 6% rates we were seeing and this new 3.45% reality is hundreds, if not over $1,000 a month in pure interest savings. That changes the qualification criteria. Suddenly, buyers who were shut out of the market because of the stress test are qualifying again. The carrying costs are becoming manageable. For an investor, a 3.45% rate might mean the difference between being cash flow negative by $500 a month and breaking even. That is huge. This rate drop is the fuel that is going to ignite the 6,138 monthly sales figure we are currently seeing. Remember those 6,138 sales? That number is suppressed, but as rates hold at this level or drop further, that number is going to climb. We are already seeing savvy buyers lock in these variable rates with the expectation that the prime rate will continue to soften. They are playing the long game. Financing is the lever that moves the Toronto market more than anything else. We don't have a supply problem historically. We have an affordability problem. And at 3.45%, the affordability problem starts to get solved. If you are a buyer, you need to run your numbers with this new rate today, because your purchasing power just increased significantly without you getting a raise at work. Final verdict. Buy now or wait for 2026. The data says we are in a rare window of opportunity, but it will likely close the moment inventory drops below 20,000. So, here is the final verdict. Do you buy now? Or do you wait for 2026? If you look at the synthesis of what we discussed, high inventory at 27,808 listings and the lower price point down 7.2%, the math favors the bold right now. We are in a classic buyer's market. This is the time to employ the low ball offer strategy. You can go in 5%, 10% under asking on those stale listings and actually get a response. You can negotiate terms that protect you, but this window is finite. The moment that inventory starts to absorb, or the moment rates drop enough to unleash that dam of pent-up demand, prices will stabilize and then climb. Timing the absolute bottom is impossible. You usually only know you hit the bottom 6 months after you missed it. My advice: don't try to time the bottom to the exact dollar. Look for the asset that matches your lifestyle or investment goals, and use the current market weakness to get it at a price that makes sense for you. The inventory is here, the rates are cooperating, and the competition is sleeping. That is the trifecta for a successful purchase. If you wait until 2026, you might find lower rates, but you will almost certainly be paying a higher purchase price, and you will be fighting 10 other people for the privilege. Be smart, look at the data, and make your move while the market is still catching its breath.